life is in investing, when we think about the mistakes we've made, we usually think about mistakes we've made. That is to say, things we did that went wrong. We asked out the wrong person at the wrong time. We didn't do well on a certain test. We lost a game. We did poorly at a presentation at work or in an interview. Something went wrong that we did. That's usually how we think about mistakes. They're errors of commission. The same goes in investing. I shouldn't have bought that stock. I should have sold that stock. I held onto it for too long. But it's also useful to learn from the things we didn't do that maybe we should have done. Errors of omission. In investing, this mostly comes down to the stocks we could have bought but didn't. Now, I don't want to take this too far because in hindsight, everything looks obvious. Of course, you should have bought Apple shares when Steve Jobs came back, or Amazon shares after the dot-com bust, or this company or that company. Of course, in hindsight, everything looks easy. And in real time, it's not quite that easy. I don't want to go there. There's so many stocks out there, and not all of them will be suitable for you. Not all of them are suitable for me. I just don't deserve the returns that certain stocks achieve. But there are times where we do the work, where we properly understand a company, where we should have the preparation we need to make an investment decision, and we just don't make the right decision, or we don't go far enough in our conviction. Today, I'm going to talk about one of those cases from my own recent past, a stock I should have invested in at the end of 2022, did not, and missed out on a big return, much bigger than I would have expected in such a short time. I'll get into that. The company we're talking about is Duolingo. You've probably heard about it, but let's break it down and get into this story. Duolingo bills itself as an education company, but you probably know it as a language learning app. The app with the owl that you download on your phone that takes you through language lessons that look a little bit like games. You progress through levels and different lessons and courses. You play flashcard games, or you can walk through fill in the blank or listening exercises or speaking exercises. There are tons of languages available. For English learners, there are all the popular ones such as Spanish, English, or Spanish, French, Italian, Arabic, Japanese, Portuguese, what have you, as well as even languages like Klingon and Hyberian, something from Game of Thrones. For non-English speakers, there's English. There's also other languages. I'm playing around with Italian in Spanish and Catalan in Spanish, for example. So it's a plethora of languages that you can learn from, all in pretty much the same format. Some are better developed than others, but the same basic outline for courses exist. The way Duolingo's business works is that if you're not paying them, you'll see advertisements. Some of those advertisements will be for Duolingo's subscription, Super Duolingo, or whatever they're calling it right now. But many of those advertisements will be the sorts you see all over the web, on YouTube, on other apps. Kind of junky ads from what I recall. Here, download this silly game or that silly game. But they're ads that make Duolingo money. 10% of Duolingo's business comes from its advertising as of the first 6 months of this year. 75% of Duolingo's business comes from subscriptions, though. Once you get tired of the ads, or if you want a few more features, you don't want to have to wait a certain amount of time after making a lot of mistakes to continue, that sort of thing, you can pay Duolingo something like $100 a year for a full year subscription. At that point, that's where Duolingo is really making its money. I like this model because Duolingo acquires a user, however, they advertise or they find a way for a user to sign up for their app. They're going to make money on them immediately as long as they're engaged with the app. And then they have an easier funnel to make more money off them. It's kind of a 2 bites at the apple approach. Spotify does this, for example. You download the app. If you're not paying for it, you'll hear ads while you're listening to music, and you won't be able to do certain things like skip a ton of songs or what have you. And if you get tired of that but still like the app, you can upgrade to a $10 or $11 a month subscription. And at that point, You won't hear ads anymore except on podcasts. Its own story. Again, 2 bites the apple, and it makes it a little bit smoother, the acquisition of a new user. I should say the rest of Duolingo's business is an English test that they sell for people who want to prove that they speak English. That's about 8 or 9% of Duolingo's business. And the rest of it is in-game upgrades. And I say game meaningfully. In-game upgrades like you get more gems. That's about 6 or 7% of Duolingo's business. Say game meaningfully because Duolingo is a gamified education platform. They really think of how can we make this more addictive? How can we make this more fun to learn? A common criticism of them is the gaming stuff is annoying, which is fair enough. And another one is you don't actually learn a language speaking using Duolingo, which I think is true. I've finished a course on there and don't feel like I can speak that language. But that's not the goal of Duolingo. They've said, their CEO has said, and you can find it wherever you look, Duolingo is trying to get you to be exposed to a language, to get confident with a language, to try the language out so that you can then take the next step. You want to go to Paris, you want to at least be able to order a croissant from the boulangerie. You get your experience with Duolingo and you feel more confident doing that. And then you do it, you feel great, and you want to learn more. That's sort of the ethos of Duolingo. I respect it. Whatever. Every company you can criticize, but I do respect what they're doing. It's vaguely been on my list of companies I would be interested in working for, given their mission and so on. And that's their model. I think it works well enough, and it's a good place to start. And evidently, it's working as a business. The company is growing very fast. And when it came public, it was growing quite fast. I'll talk about their IPO in a second. The company is just now starting to get profitable, though it's not very profitable, which is one of the concerns I'll discuss. But all in all, this was a little bit of a Peter Lynch thing for me. Even though I didn't know it was going public until a couple days before its IPO, and even though I hadn't used the app yet, I have since become a subscriber and use the app regularly. I understand language learning. I've worked in subscription businesses, so I understand that. And even where I worked at Seeking Alpha, we had a similar sort of, we make some money from advertising before you sign up. And then once you sign up, we're making the subscription revenue. So that funnel made sense to me. Let's go into its IPO to sort of set the scene for what it could have done if I had invested in Duolingo in 2021 when it came public. When a company comes public in the US, it files an S-1 form. This is the form for new companies that are introducing themselves to the public market. If they're based somewhere else, but filing on the US market, it'll be an F-1 form, and each country has their own corresponding form, a company to file as they introduce themselves to the market. The S-1 form is sort of like a 10K, except a little bit more grandiose because it's, again, the company's opportunity to introduce itself. So they really want to lay out their mission. They want to lay out all the metrics that matter. They want to lay out, in Duolingo's case, anecdotes for why the company matters, why it is achieving its mission, how it helps people, all those sorts of things to really help investors understand, what am I getting into if I invest in Duolingo? Duolingo came public in July 2021. I heard about it only a couple days before it went public, that it was going public. I hadn't thought about it. And I dove into the S1. I had some time on my hands. I was curious. I didn't expect to invest for reasons I'll explain in a second, but I liked what I saw in their business. I've already explained sort of the business model and how it works. I liked that they were growing quite fast. They ended up growing 55% in 2021. But what I liked about that was Duolingo was the rare company that benefited from COVID because as we were stuck at home and didn't have what else to do, we could either learn how to bake sourdough bread, or we could do something like download an app to practice a new language. And a lot of people did. Their user growth jumped dramatically at the beginning of COVID. But at the same time, Duolingo was going to benefit from reopening because then we would be able to travel again. And as we travel to places outside of our country, we're going to want to speak the language. And a Duolingo app is going to again be useful. So they had this sort of two-part tailwind behind them that not every company had. The Zooms of the world, for example, had the COVID benefit, but not the reopening benefit. The travel companies had the reverse. Duolingo kind of had both. Another thing I like about their business, their free cash flow is, I don't remember if it was positive in the S1, but had positive dynamics. Because they were a subscription business, They collect the subscription payments up front. That helps them in their cash flow, even if they're not yet profitable. They get the money early. This is a positive dynamic for business. It's called negative working capital. Amazon is probably the most famous company for having this, both from the Prime subscription and the way they negotiate with suppliers. And it's a good dynamic to have as long as you're growing, which, as I've just said, Duolingo is growing quite healthily. Things that scared me about the IPO were mostly Duolingo's commitment to continue to grow their R&D at a large, fast rate, their research and development. They're going to continue to invest in their business so that they improve the app, so that they make it more useful for learning and continually addictive for users to stay on the app. That's my language, not necessarily theirs. That's a big expense. Their sales and marketing jumped quite a bit as well leading up to the IPO, which is always a little suspicious because it seems like you're trying to make your numbers look better before you go public by attracting more users or what have you. But also, again, sort of a how much is this going to continue to grow? They said that would slow down, but it was something I wanted to watch. And their G&A, their general and administrative costs, were also growing quite fast. All of these were challenges that they had. One last challenge is that because it's an app, the company doesn't have total control over its business, by which I mean to say they basically sell in Google's Play Store and Apple's App Store. As part of that, they have to pay those companies quite a bit of money for any subscribers they get. 30% for their first year of a subscription, 15% for their second year of a subscription. That means their gross margins are going to be limited at a certain point. Not a terrible limitation, but gross margins of 70% for a software company are somewhat low. That was going to be a challenge for Duolingo over time. But the biggest reason that I knew that I wasn't going to invest in the IPO has to do with IPOs themselves. Because you have to think about what's happening in IPO. A company is selling a piece of itself. Either they're doing it because they really need to raise money, which a little bit concerning because that means that they have to really invest, or they think that the shares are a high price and they think it's a good price to sell, whether it's for insiders, the company itself, whatever, they think this is a good price. That's part one. Part two is this thing called the IPO window, which is a vague, abstract notion, but the idea is companies come public when markets are opportune and open to new companies, meaning that things are frothy, buoyant, prices are really high, valuations are really high. You're going to expend a lot for the earnings that you can expect to receive from a Duolingo or from a newly public company. Airbnb was another example of this. Whenever a company comes public, they're by definition trying to get all the money they can. Facebook famously priced their IPO really high, and then the stock dropped more than 50% after it went public. Of course, things worked out great from there on, but you have to keep that in mind when investing in IPO. There's also a lot of volatility around an IPO. It's just hard to tell what the normal trading is going to be until things settle out and until the company reports earnings a couple times. I generally don't invest in IPOs, and Duolingo was no exception. It had originally planned to go public at $75 a share. It raised that value to $95 to $100 a share, and on its first day of trading, it closed at $140 a share. That's almost 100% range. And that meant that the company was valued at $5.6 billion, or a little over $5 billion if you give them credit for their cash. And even last year in its full, or 2021 in its full year, the company only made $242.5 million in sales, if I'm not mistaken, somewhere around there. In other words, it was trading at more than 20 times sales for that year. That's a very high number, and we have to use sales because it wasn't profitable yet. For all that its cash flow had positive dynamics, it wasn't profitable yet, and said, we're going to be investing a lot of money into continuing to improve our product. We don't know when we're going to be profitable. All of that, it was just too steep a price for me. I liked the company quite a bit, but even at 75, I would have said, this is quite a lot. And so I stayed on the sidelines and kind of watched from afar as the company evolved. Let's talk about what happened in Duolingo's early public career. Duolingo's first year or so on the public markets was pretty solid in terms of their performance. The stock continued to grow, the company continued to grow, the company continued to raise their expectations, their guidance, and so on. There were no real red flags in the business itself. The stock stayed elevated for several months after its IPO, but in 2022, as with much of the market, its shares started to sell off. Not again necessarily for anything Duolingo was doing wrong, but because markets were getting a little bit more rational about how they viewed tech companies, especially, and companies in general and their valuations. We always have to keep in context what's happening, and that's where a longer term perspective is useful. Stock markets were trading well in advance of where they were before the pandemic, in part because governments around the world pumped a lot of money into the economy to keep things flowing while we were shut down. But at some point, things do have to rationalize a little bit. We didn't see a recession 2022, but we saw a bear market, especially in the NASDAQ, and a lot of these companies came down. By the end of 2022, Duolingo was below the $75 price I had mentioned as their original IPO price. Meanwhile, nothing bad was necessarily happening to their business. They weren't profitable yet, but free cash flow was okay, and the company was growing quite fast. They would end up growing 55% in 2021 revenue and 47% in 2022. That's really impressive. That's hard to do. And it's not a huge amount of sales. They only finished last year with about $370 million in sales, but that's real sales. You don't have to get so far with that speed of growth to start making real money. Duolingo still appeared to be a leader in its field. It's still something everybody knows about. Their social media game is really on point. Everybody knows Duo, and they're quite funny in different places. It had a good position, and I was getting interested again. Let's go over my checklist again, or the things I look for in a company in a stock, set the scene before we get into my mistake at the end of last year. I say I want 4 things from a company. Let's start there. Revenue growth. You've just heard 55%, 47%. Those are huge revenue growth numbers. I almost never invest in companies like that just because they're so expensive. Talk about the stock in a second. Really strong there. I understand the business both as a user and a language learner, and from the perspective of this free to paid flow and how subscription businesses work and what to study in subscription businesses and so on. That was okay. The company had a very strong balance sheet, no debt on it. They raised a lot of money with the IPO, and their free cash flow was, if not positive, around zero. It wasn't they weren't burning cash, partly because they're printing new shares for their employees. That's a real cost, but it wasn't like it was going to need money from the market. In terms of operational control, I mentioned the issue with Google and Apple, and they didn't have control over that. But Google lowered their rate to 15% even for the first year of what they would take from apps like Duolingo. That would save them some money and improve Duolingo's margins. And Apple hasn't changed yet, but has continued to get pressure. Apple, for whatever reason, has avoided the antitrust scrutiny that a lot of companies have had, but it's inevitable that they're going to get some. And it seems like you have that as sort of in your back pocket, the chance that someday Apple will have to bring down the take rate that they take from subscriptions in the first year. If that comes down to 20%, for example, Duolingo's gross margins go up about 8 to 10% overnight. That's something that's still out there. So in terms of not having control, that's one of the things that actually the not control is a bad is good case where it could get better without too much effort. The last thing I look for is efficiency, which Duolingo is still investing a ton in R&D. That hasn't really slowed down its growth, but they have started to see, especially now I'm flash forward to 2023. In this year, we've really seen sales and marketing growth slow down, and general and administrative growth slow down, which were the 2 lines I was curious about because that's really where they should be showing leverage, where the new dollars they're making in revenue should really lead to more dollars in profit. So that was positive. Their efficiency, room to improve. That's still the black mark in terms of the company, but we should be able to see that over time. In terms of the stock, still tough to make an attractive valuation case. I made a discounted cash flow when the company came public, and I was probably too pessimistic about their growth, but I had some optimism about how they would do with margins more than they did. And I wasn't able to I got to 2027, $4 a share in earnings. which at $140 a share is still something like, in the quick math, 35 times earnings, which is a lot if I was paying for earnings this year, let alone 2027 earnings. At $75 a share, all of a sudden that gets a lot more interesting. That gets to something just under 20 times shares, just under 19 times earnings. Okay, that's actually a pretty good multiple, but that's still in 2027. That's still way out. They would need to continue to grow and to show this efficiency for this to make sense. At the same time, as I was looking at the stock as it was dropping below 75, I was starting to think sentiment is really bad for these tech companies, and their businesses are fine. They're not maybe going to grow to the moon, but they're in an okay shape. So something's not adding up here. I do think there's some disconnect. I can't make a strict valuation-based risk reward, but it does seem like we're closer to the bottom of something than we are to a top. That makes it interesting. The disconnect seems to be pretty clearly just macro stuff, just concerns in the market about these sorts of companies. The sorts of people who own shares in these are being forced to sell off for different reasons, tax law selling, all these other things that kind of cycle on themselves, loop over and amplify moves like this. So I thought I understood the disconnect, even if I was still struggling with the valuation part of it. So the stock wasn't a perfect position, but for a company like this that is still growing fast, that I understand and that I think has a pretty good business model, you don't get a lot of great opportunities. That left me in December of 2022 thinking, okay, maybe I should actually start putting out buy orders for Duolingo. And I did. So what went wrong? I put out a couple buy orders for Duolingo in different accounts I run at about $60 a share. The company bottomed at $65 a share. From there, in 2023, a lot of these tech companies had a huge rebound just from the inertia of the market, the January rally, all these things that basically just things that go down tend to go back up if there's no business reason for them to stay down. Duolingo's shares rose something like 40% through the end of February before it did anything. Then it reported earnings that were pretty good and better than the market expected, apparently, and the stock rose another 50 to 60% in March. That means it doubled in less than 3 months from its bottom at the end of December to March. From there, it's kind of stayed up in that 140 to 160 range, which, again, more than a double from where it was at the end of last year. It's continued to grow pretty impressively. I can't remember exactly what it's predicting for growth this year, but it's expecting about $513 million in sales this year, which compared to 370 last year. That's pretty impressive growth. I think it's somewhere around high 30% growth. The company is continuing to do well. It was actually profitable in the second quarter this year. It's a little bit ironic profit because they made money because they have so much cash on the balance sheet, so they earned interest, which pushed them into profitability. But still, that's, again, a sign of strength. They have a ton of cash that they can use either to acquire a company or to just invest and make money as they get over into profitability. They're growing fast. They're looking at expanding into new markets, which I'll talk about in a second. And yet I don't have any shares. Why? Probably 2 reasons. I probably didn't do enough of updating what I thought could happen with Duolingo, which might have given me a chance to be more excited about the opportunity. If I really adjusted my models, I might have seen, oh, okay, this is actually where this makes sense. And also, I put an order at 60. I anchored at 60. And this is where, in hindsight, this looks obvious. But at the time, everything's going down. You don't know where bottom is. You don't quite have the valuation that you're confident about to buy in. And so I wanted to be disciplined, and I kept my buy order at 60. I didn't raise it to 65. I wasn't opportunistic, and I missed out. I didn't get the Duolingo shares that I wanted. I missed out on a more than 100% move, and here I am left talking to you about it several months later. What lessons can we learn from all of this? There's a concept I like that I kind of hinted at earlier, which is that if you don't do the work, you don't deserve the return. Meaning, every stock at any point is a collection of probabilities. If you do enough research and enough thinking, enough analyzing and understanding of it, so that you can see that a seemingly expensive stock actually isn't, or a seemingly cheap stock actually isn't, and you avoid it, then you deserve that. You've done the work, you understand it. In my case, I didn't do enough of the work to deserve Duolingo's returns. And also, I should say, it would have it would have been a funny, weird. I don't know if I would have been able to hold on to it the whole time. I've been burnt when I try to hold on to stocks forever, even though they've well shot past my valuation. In this case, I would have bought Duolingo at 60 or 65. And when it got to 100, I would have been thinking, that's really okay. It's more than fully valued. And then when it gets to 140, I don't know how much I would have held on to shares. So I have to be honest with myself that I didn't deserve to get the Duolingo returns that have manifested in the past 9 months or so. I did, I should say, make a similar investment in another company that I like, understand its business model, am interested in it as a user and as somebody who's interested in this field, which I've already mentioned, Spotify. Spotify has played out similarly. And some of this is just, again, a lot of these tech companies got oversold last year because there was such pessimism, but their businesses have been fine. They've managed to prove that they can be profitable and they've grown reasonably well. Spotify was a similar story. I have made over 100% on so far. It's not a big position. I don't deserve to make more. I still think it's fully valued. I've sold a few shares, but that's an example of, okay, I didn't totally miss out. Have a similar theme. I played it out. But I think the last lesson to keep in mind, two lessons. One is to not get too cute on entry prices. If you think something's worth 60 and it's trading for 65, that's a difference. It's almost a 10% difference, but sometimes you can stagger your buys in and make that buy, and then you can continue to buy if it goes lower, or you can continue to update. And even more than that, when you're interested in companies, you don't have to buy right away. In hindsight, it looks like I made the right decision to not buy at IPO or in Duolingo's first year plus as a public company. But it's not enough to just have that idea and then kind of keep an eye on it. You have to continue to update your thinking. It's good to have an active watch list of companies you like, whose stocks you don't quite like yet, but you have to keep maintaining your eye on the ball. You have to say, okay, now it's growing at this rate, which is much faster than I expected. So I should be doing X, Y, and Z to update how I think about it, that sort of thing. We can only keep track of so many companies. I like to, if I were an individual managing just my own money, I would be targeting 8 to 10 stocks as the number of stocks I could own, because that's the number that I can really gather, gives me decent diversification, and I can really follow, and it'll make a difference if I get it right. So then you can track, let's say, another 10 to 20 stocks. That's a lot of companies to keep track of. But when you're doing this sort of thing, maybe periodical check-ins or whatever, keep updated, keep aware, don't get too cute at the entry price, and also realize sometimes you just haven't deserved it. You just don't get it right. It's okay. I don't sit lying at night regretting I didn't invest in Duolingo. I do think it's a good example, though, of a company that checked a lot of boxes, that I understood, that I had done some of the work at least on, and I had made partially the decision to make a move. I just wasn't confident about it. I didn't make the buy I needed to. I messed out. It'll happen again, but I hope that this will be a useful lesson for you as well as it is for me. In my next video, I'll talk about another lesson from my investing experience. Got a couple more left before I start moving to other investors. I'll either talk about a stock that worked out and walk through the lifespan of that investment and how that worked, or a stock that didn't work out and what I thought, what I got wrong, and how I tried to learn from that. Stay tuned. Check out shortinvestingguide.com for more on Duolingo and more on my investing. Thank you for watching, and I will see you next time.